I'm going to do my best to stay even keeled during this. Because one of the companies that I've invested in is called Transmedics. And the company has a really important mission. It's basically to help save more lives by making the organ transplant process more effective. It does it by creating machines that keeps hearts, lungs, and livers, and soon, hopefully, kidneys alive for longer through warm perfusion. And not only that, but they built out a logistics network to get these organs from point A to point B as quickly as possible. So the company reported after earnings today, and as you can see, the stock immediately went up about 10%. But if you can see right here, this is where the company's CEOs and co-founders started talking. After that, it was a steep dive down, and I do not blame investors for doing this. It was an incredibly, maddeningly frustrating process. Let's talk about what happened during this quarter. It was Transmedics' second quarter. The market cap will be between $2.5 and $3 billion next year. Now, revenue was up 21%, beat analyst estimates. So far, so good. Adjusted earnings per share, which is what analysts were basing this on, came in at 44 cents. That's down 52% per year. A fall was expected, but it did miss analysts' expectations. Now, margins weren't pretty, and some of this was expected because the company is heavily reinvesting in itself for new heart FDA approvals, lung approvals, and kidney approvals. And during this process, this does affect the margins because while they're running these trial runs, they do get paid for some of them, and that can affect these things. Gross margins took a step down. That's important. We'll get to it in a minute. Operating margins took a big step down. That's important. We'll get to it. Net margins, I'm less concerned about. It's the operating margins I'm concerned about. And on that note, with the operating margins, when the company reported earnings just 90 days ago, they said that operating margins, adjusted operating margins for the year, would be at 16%. But they have lowered that to a range of 12.5% to 14% because of sooner investments in their kidney platform, which on the surface is great, but that is really something that you should have been forecasting and sandbagging a quarter ago. This is amateurish to me based on 15, 16, 17 years of being an investor. Free cash flow was down. That was to be expected. Net income was down, but that was to be expected. The balance sheet is getting a little bit better. The investments in this logistics network and trying to start up a business abroad force them to take on debt, and that's not the end of the world. If we look at the income statement, total revenue was up 21%. But the cost of that revenue is up 26%. Now, it's important that we differentiate between product revenue, which are consumables and the machines that keep the hearts, lungs, and livers alive while they're transported from point A to point B, and service revenue, which includes logistics or flying these organs from point A to point B. Let's go through the differences here. Product revenue, gross margin, fell from about 80% to 77%. It was a 280 basis point contraction. And on the call, management did not offer really great explanations for why this happened. It was very underwhelming. Now, 300-ish basis points is not the end of the world. But when there's not a clear and concise explanation for this, that just adds fuel to a fire where there might not be a fire. Service margins were much better. They went from 32.5% to 35% margins. Now, the company said that we should not expect them to stay that high in the future. The reason that it was so high was because there was more organs being transported, and the double shifts that the company had was helping their efficiency. We'll get to service revenue again in just a minute. But these forces combined to make gross profit grow not much, but 400 basis points slower than revenue. Revenue is 21%, gross profit was just 17%. That's bad, that's why it's coded red. The operating expenses exploded. Again, this was to be expected. The company is investing in its OCS kidney, which is the kidney program. It's investing in Enhance, which is the next generation heart, in De Novo, which is next generation lung. And those things, they they eat up clinical trial and R&D money. And as you can see, that basically doubled, which is why income from operations fell by 35%. Net income was down even more. The number of shares outstanding was roughly flat. Let's look under the hood a little bit more. I'm going to head over to fiscal.ai for this. And what I've done is I've pulled up a couple different things. These are the revenue streams for the company when it comes to their products, not the service, but the products. So this is revenue that they got for organ donations of U.S. liver. As you can see, organ donations in the U.S. is the bulk of revenue. After that is U.S. heart. This tiny orange one right here is U.S. lung, and this purple is international revenue for transplants. So what I want to show you is that when we look at the lung revenue, it was shrinking, but it really doesn't matter because that orange piece is so small. The heart revenue was up 4% year over year, but also small, and we're waiting on enhance to come through. The liver continues to be very strong. Now, I know that this looks like a huge deceleration, but what you got to realize is these numbers were crazy high before. The liver grew 28% last quarter, grew 28% this quarter. That's pretty good. That is pretty good. And then revenue from outside the U.S. was overall up 26%. It's a small chunk, but the real story here is that the liver performed pretty well, and that's great, and we should be happy about that. Now, there's product revenue and there is service revenue. Again, this has to do with the consumables and the machines that keep the organs alive for longer. This has to do with the logistics and the technicians that have to travel with it. There was a lot of questions on the call about this because if we look, the product revenue grew 16%, which is fine. It's not great, but it's been well understood that the company's real growth is going to come from the kidney and from the next generation heart and lung and from international growth. But this service revenue growing much faster at 29%, that was the big question. And this is where management stumbled woefully. It was really, really bad. I think that this could have been explained really simply. They said that if I'm remembering the numbers correctly, between 80 and 82% of all organ donations used the transmedics logistics to get the organ from point A to point B. 80 to 82% in the year ago quarter. It was up to 86% in this quarter. So obviously some of that growth, 4 percentage points above the 16, will be accounted for by the simple fact that more of the organ donations use Transmedics network. Another thing is that the overall number of organs transplants grew as well if we're to use the revenue growth as a proxy. So not only did the pie grow, but the percentage of the pie covered by service grew, and the company said that they raised prices for fuel because of what's happening in the Middle East. And that covers most of it. But the company danced around this in ways that just were utterly confusing, and you could see this is when the stock started falling and falling and falling after hours. Now, if we look ahead, management raised the midpoint of guidance and they're calling for 23% revenue growth this year, which is better than what analysts were expecting. However, that also comes with those adjusted operating margins being revised downwards from 16% to a midpoint of 13.25%. Now that might not seem like much, but that's actually a pretty significant haircut. What should investors watch moving forward? Number one, by far, gross margins, especially for product revenue. If those margins are falling, the story that could take hold in the market is that Transmedics has to lower the price for their consumables and their machines because there are alternatives that can get the job done for cheaper. And since I and many other investors aren't heart surgeons or transplant surgeons or lung or kidney or liver surgeons, we're not in there to know about which machine is being used. And so this is the clue that tells us gross margins. Number two, guidance on revenue. Number three, any updates on new rollouts for Enhance, De Novo, Kidney. And number 4, the liver growth, because that is the most important. I think that the moat is stable around this company. I am cautiously optimistic. Although many of these slides I finished before listening to the call, but I wanted to listen to the whole call before we got to it. And so I'm not 100% sure what I'm going to do with my shares. Now, if you're interested in what I might do with my shares, I want to let you know about my investing program, Stock Investing Mentor. It has 3 pillars. Pillar number 1 is you get full real-time access to my real-life portfolio that is 90% of my family's net worth. Number 2, and importantly, you get access to the antifragile stock universe. Every stock that I own and follow, scored on the antifragile framework, scored for valuation, and I tell you what are the 2 or 3 most important metrics to watch when these companies report and what would be good, medium, or bad. And 1 hour of live weekly training every week, Thursday, noon Eastern, and 24/7 access to a private online investing community. If that interests you, top link in the show notes below will get you a year-long membership for 10% off. But not only that, you will get Stock Simplifier absolutely free. And this is a tool that is worth $400 a year. Let me show you how Stock Simplifier works, because we're going to use this to figure out valuation with Transmedics, and you can see why I would still be willing to hold this company even though that was a very frustrating conference call. Now, usually you see me do reverse DCFs here, but what I want to focus on for Transmedics is I'm going to use this really awesome tool that we've got, which values a company based on its total addressable market. Now, I'm going to use this in a way that's a little bit different than most times. The company has made some projections. They have said that by 2032, they will be able to have 30,000 organs, help transplant 30,000 organs annually. That will come, the company will grow from about 5,000 last year to 10,000 by 2028, just through heart, lung, liver, primarily in the US. They will get from 10,000 to 20,000 in just 2 years by bringing kidney on board. And then they will go from 20,000 to 30,000 by 2032 through international expansion. So by 2032, they expect to be able to do this. Now, in the bull case, I'm assuming that they get all 30,000 and that each transplant has an average revenue of $100,000. Now, I'm being conservative. That's lower than where it is today, but that would be $3 billion in revenue. In the base case, I'm assuming that it's $90,000 per organ and they hit 25,000 organ transplants total. If that were the case, then the company would have $2.25 billion in revenue. And in the bear case, I'm assuming that they just hit 20,000 transplants by 2032, averaging $80,000 per transplant. If that were the case, then that would be $1.6 billion. Now, that's not really a total or a serviceable addressable market. So I'm going to pull these market shares all the way up to 100%, because what I'm saying is that I believe that this is what the revenue number could be in a bear case, a base case, and a bull case by 2032 if we are to believe management. What about profit margins? I'm going to be somewhat conservative. The company thinks that it can have operating margins of 30% at a steady state. I'm going to put this at 20% for the bull case. Let's make this about 22% for the bull case. We'll make it 17% profit margins or free cash flow margins in the base case, and we'll just keep it at 12% in the bear case. And how much might they be willing to pay for this? Well, I think that if in the bear case, it might just be about 10 times PE. I think in the base case, it would make sense to be able to trade that for about 25 times if it's growing that fast. And in the bull case, this could easily be 40 times earnings. Now, how likely are these scenarios? The company does keep pushing things out. It does refigure how much they are going to have in margins over the short term and kick things down the road. So I'm going to say, let's just say there's only a 10% chance of hitting that base case. Even with a 10% chance, just a 10% chance of hitting the base case, I want you to pay attention to this number right here. And a 10% chance of the bull case, the blended market cap would still be market matching, about 10% per year. Okay? Let's say that we pull the bull case just down to 1% chance of happening. Well, then this is not worth investing in. Let's say that we think that there's, let's say, a 25% chance of the base case. Not looking good. Let's say that there's no chance of the bull case happening, but we'll say there's about a 1/3 chance that this company can hit its base case. It's still not worth it. So you got to see that what an investment in this is really banking on is management hitting 30,000 transplants by 2032 and having roughly a 22% profit or free cash flow margin by that time. And if they can do that based on this potential PE, then it could make sense. But if they fall short of that, then it's not going to look good. The thing that makes it so confusing is that if you just look at the numbers, it's not that bad. But if you layer over top the obfuscation or just really poor job of communicating what's going on inside the company, it just introduces a lot of doubt. And so I'm going to spend the next couple of days trying to figure out how to weigh these two things moving forward. I'm curious what you think. Let me know in the comments section below. And until next time, Brian, out.